You see the headlines about market crashes and your stomach just drops. People keep saying you need to invest to get ahead, but the fear of losing your hard-earned money is completely paralyzing. It feels like you're standing on the edge of a high dive, knowing you should jump, but your feet are glued to the board. Before we start, make sure you hit that like button and subscribe to the channel. If you want simple, practical strategies for building wealth, understanding investing, and escaping the paycheck-to-paycheck cycle, you're in the right place. What if I told you that this fear, while totally normal, is actually making sure you lose money every single day? Today, we're going to break down the psychology of why you feel this way, why your brain is basically hardwired to be terrified of investing. Then I'm going to give you a dead simple, step-by-step game plan to finally start building wealth, even if you're scared of making a mistake. This isn't about being fearless. It's about having a plan that makes fear irrelevant. Part 1. The problem and the psychology of fear. First things first. If you're scared to invest, you're not broken, you're human. Our brains are survival machines, and for most of history, that meant avoiding immediate threats. A tiger in the bushes is a clear danger. To our ancient brains, the stock market's wild swings feel exactly the same. This is rooted in a few weird quirks of our psychology. The first is called loss aversion. Behavioral economists have shown that the pain of losing feels roughly twice as powerful as the pleasure of gaining. So, losing $100 stings more than finding $100 feels good. Your brain isn't trying to make you rich. It's desperately trying to avoid the pain of loss, which makes putting money into something that could go down feel incredibly dangerous. Then there's the fear of regret. You aren't just scared of losing money, you're scared of making a dumb decision and having to blame yourself for it. What if you pick the wrong investment? What if you buy at the exact worst time? This leads to the third trap, analysis paralysis. You decide to protect yourself by learning everything. You read books, you watch videos, but instead of building confidence, the mountain of information just becomes overwhelming. You get stuck in eternal research mode, thinking you just need one more piece of information before you're ready, but ready never shows up. The news cycle makes this 1,000 times worse. They don't run headlines like, "Market went up a little today, pretty normal." They scream about crashes, inflation, and economic doom. Your brain clings to this dramatic, recent info, a quirk called recency bias, and concludes the market is a house on fire, even when history shows it's more like a sturdy, long-term skyscraper. Now here's the kicker. While you're safely on the sidelines, you're guaranteeing a loss. That's because of inflation, based on official data from the U.S. Bureau of Labor Statistics. The annual inflation rate for the 12 months ending in April 2026 was 3.8%. What that means is if you had $10,000 sitting in a checking account over the last year, it now only has the purchasing power of about $9,620. You lost $380, not from a risky investment, but from doing nothing at all. The cost of everything went up and your cash just shrank. This is the ultimate mindset shift. Risk isn't just about what you could lose by investing. It's about what you are losing by not. The choice isn't between risk and safety. It's between the short-term, up and down risk of the market and the slow, silent, guaranteed risk of inflation. Part 2, the dead simple anti-paralysis strategy. Okay, so your fear is normal, but sitting in cash is a losing game. How do we break the paralysis? By making the first step so simple and so safe that it feels almost effortless. This has nothing to do with picking the next hot stock. It's about building a system that does the work for you. Here is the dead simple 4-step strategy to get you started. Step 1. Build your financial foundation. Before you invest a single dollar, you need a safety net. This is non-negotiable. An emergency fund is what gives you the psychological courage to invest for the long haul. Without it, every market dip feels like a personal crisis, and you'll be tempted to panic and sell at the worst possible time. Your foundation has 2 parts: paying down high-interest debt, I'm looking at you, credit cards, and building an emergency fund of 3 to 6 months of essential living expenses. Keep this cash in a high-yield savings account, safe, accessible, but not too accessible. Once that's handled, you're ready. Step 2, choose the right account. This sounds complicated, but it's not. For most beginners in the US, you've got 3 main options. If your job offers a 401k with a match, this is almost always where you start. An employer match is free money. Many companies will match your contributions, often giving you a 50% or 100% return on your money instantly, depending on their formula. It's the best deal in finance. If you don't have a 401k or you're already getting the full match, look into an ERA individual retirement account. A Roth IRA is a fantastic choice for many people. You put in money that you've already paid taxes on, and it grows and can be withdrawn in retirement completely tax-free. Finally, there's a standard taxable brokerage account. It's the most flexible but doesn't have the sweet tax perks of a 401k or IRA. Don't get stuck here. Just pick one and move on. Done is better than perfect. By the way, if this is clicking for you and you're ready to finally take back control of your finances, do me a favor and hit that subscribe button. My whole goal is to make this stuff simple and actionable, and I'd love to have you along for the ride. Step 3. Choose your investment, the what. This is where most people freeze. They think they need to find the next Amazon. You don't. In fact, you shouldn't even try. Instead, you're going to buy the whole haystack, not search for the needle. The easiest and most proven way to do this is with a low-cost, broad market index fund, or ETF. The most famous one is an S&P 500 index fund. Think of it like this. When you buy one share of an S&P 500 fund, you're not buying one stock. You're buying a tiny slice of 500 of the biggest, most successful companies in America. You're instantly diversified. If one company tanks, you have 499 others to balance things out. You're not betting on a single horse. You're betting on the entire U.S. economy to grow over the long run, and historically, that's been a very good bet. While it's no guarantee, the S&P 500 has historically delivered an average annual return of around 10% when you include reinvested dividends. Step 4. Start small and automate everything. This is the magic key to overcoming fear. You don't need thousands of dollars. You can start with $100 a month, $50, even $25. The amount you start with matters way less than the habit of starting. Once you've picked your brokerage, your account, and your index fund, set up an automatic transfer and an automatic investment for the same day every single month. This does two incredibly powerful things. First, it rips emotion out of the equation. You're no longer deciding if it's a good or bad time to invest. The decision is already made. The system just runs. It's the ultimate antidote to fear and second guessing. Second, this lets you use a strategy called dollar cost averaging. When you invest the same amount on a fixed schedule, you automatically buy more shares when prices are low and fewer shares when prices are high. It literally forces you to buy low, which is the name of the game. Part 3. Overcoming the final hurdle and your first step. I know what you're thinking. What if I invest my first $100 and the market crashes the very next day? It's a valid fear. And the answer is, in the short term it would feel awful, but in the long term it wouldn't matter. In fact, it might even be a good thing. History proves it. The 2008 financial crisis was terrifying. But if you had invested at the start of 2008, by 2026, your investment would have grown by over 570% with dividends reinvested. More recently, during the COVID crash in March 2020, the market felt like it was in a freefall. But just 1 year after the bottom on March 23, 2020, the S&P 500 had surged over 76%. The lesson is this: market crashes are a normal, repeating part of the investing journey. They feel like a 5-alarm fire at the moment, but for a long-term investor who is consistently adding money, they're actually a sale. When the market is down, your automated investment is just buying you more shares at a discount. Think of it this way: volatility is the price you pay for higher returns, so let's land the plane. You're not scared to invest because you're bad with money. You're scared because your brain is built to avoid uncertainty. But keeping your money in cash isn't safe. It's a guaranteed way to lose buying power year after year. The way to beat this fear isn't by becoming a financial genius overnight or waiting for the perfect moment that will never come. The solution is to create a simple, automated system that makes your fear irrelevant. Build your foundation, open a retirement account, and set up automatic investments into a low-cost index fund. Your goal is not to be perfect. Your goal is simply to start. Confidence doesn't come from more research. It comes from taking action over and over again. So here is your final call to action. I want you to take one tiny, tangible step today, not tomorrow, today. Maybe it's just calculating your 3-month emergency fund number. Maybe it's opening one article that compares two brokerages. Or maybe it's finally opening that Roth IRA account you've been putting off. The journey to building wealth doesn't start with a giant leap. It starts with a single, manageable step. Go take that step now.